Hello investors, welcome to Simpli Stocks. In the third video of our 7 stocks for market correction series, today we will be discussing a well-known large cap solar manufacturing business. This stock has not only seen a price correction, but it has also gone through a long phase of time correction. In fact, there was some negative news and then the negative sentiment had already started building around this business even before the war. However, during this period, the company has continued to deliver consistently strong results, because of which it is now trading at a very attractive valuation and also very attractive PE ratio. But before we move ahead, as a SEBI registered research analyst, I need to give you a disclaimer that I am invested in this business and it is also part of the tracking list of my research desk. So please keep that in mind. The business I will cover today is Waaree Energies. You will notice that despite being such a large company with almost 90,000 crore rupees market cap, it is trading at a PE ratio of just 25. It is written here that stock is about 20% down from its 52-week high. But if you look at the chart, you will see that the stock has been sideways for quite some time now, and it has also gone through a long phase of time correction. While their sales and profits have been growing consistently, both on a year-on-year and quarter-on-quarter basis, their module and cell capacity had gone live, because of which we are seeing such strong earnings growth. In the first 3 quarters of FY26, Waaree has earned a total net profit of around 2,750 crore rupees. And if we make a rough assumption and account for the March quarter results as well, the full year PAT can easily cross 4,000 crore rupees. So the 25 PE ratio that I mentioned will be even lower on a forward basis. But then an obvious question comes, why is this business trading at such a low valuation? So let us understand that. One reason is that the company has faced several surprises from the USA. The US is a major market for Waaree and they have also a module plant there. But US Customs started an investigation on Waaree, suspecting that it was importing cells from China and supplying them to the US. Since the US has banned Chinese solar products, this created concerns. On top of that, tariffs were also announced on Indian solar products, which added to the negative sentiment. But the key highlight here is that Waaree is not directly affected by these issues. Throughout this period, the management has been very transparent. Whenever any negative news came out, they addressed it openly through interviews and clarified the situation. For example, this US Customs investigation is not a one-time event. Such investigations have also happened in the past as well, and these are regular type of investigations. Also, regarding the tariffs imposed by Trump on Indian solar products, what Waaree does is that it imports cells from other South Asian countries and then supplies them to the US. The Indian DCR cells are largely consumed within India itself. But in the stock market, people often react only to the headlines. So even if the actual impact is limited, the stock still gets affected due to the negative sentiment. And that is what has happened. Now, apart from this, another major risk that affects solar sector is the risk of oversupply. Companies are adding capacity at such a fast pace that there is a concern that supply may exceed demand, which will lead to price war and thus fall in prices of solar modules and solar cells. So margins are going to contract for solar manufacturers. That is a big concern. This is why we have seen derating across the entire sector, from Waaree, Premier to Websol. But there is an important point to understand here. See, bringing new cell capacity takes time. So this oversupply issue for cell manufacturers is still 2 to 3 years away. Also, solar modules and cells are two different things. Modules are made by combining multiple solar cells together. Right now, the excess capacity is mainly in solar modules, because of which module prices have fallen sharply. However, in cell manufacturing, margins are still intact, very high, which is benefiting integrated players like Waaree and MV. Right now, in pain are those companies that only make modules. Another important factor is that it takes around 4 to 6 months to make 1 gigawatt cell line fully operational and stable. Solar cells are delicate products, so you have to manage both breakage on one side and then efficiency on another side, which makes scaling up difficult for cell manufacturing. Because of this, cell manufacturers are enjoying higher margins and higher profitability, and this advantage is likely to remain for the next 2 to 3 years. There is one more point. Under the ALMM framework, around 55% of existing cell capacity is based on older technologies which have lower efficiency. New rules require solar cells to have at least 22% efficiency. So a lot of older capacity and smaller manufacturers may become obsolete or get phased out. So yes, the sector will eventually become commoditized. That I agree with. This happens in almost every industry. So that will happen. But see, early players made a lot of money in module manufacturing, but as competition increased, module prices fell and margins declined. Now, cell manufacturing is the space where margins are high. So companies like Waaree that are already making cells are benefiting from it. But over time, even here, margins will normalize. But what will happen is that stronger companies will move further back into the value chain and backward integrate into ingot and wafer manufacturing. That is where they will earn higher margins next. So in very simple terms, those solar companies that are rapidly backward integrating across the value chain will have a strong competitive advantage, and they will continue to enjoy abnormal profits and higher margins. And this is exactly what differentiates Waaree Energies. The company already has a capacity of 5.4 gigawatt of cell capacity, and another 10 gigawatt is being added within this financial year. On top of that, they are also entering ingot and wafer manufacturing with 10 gigawatt capacity. But see, Waaree Energies is just one business that is available at an attractive price during this correction. There are many other businesses in the market that are not affected by the war, but they have still corrected due to the broader market fall and are now trading at good valuations. Apart from this, there are also many contra bets, or basically the stocks that have corrected because of the war, but they have such strong business models or fundamentals that they can easily get through this uncertainty of 2 to 4 months. That is why this Sunday, on 12th of April, I am conducting a webinar where I will be discussing such quality businesses that are currently trading at attractive valuations due to the correction. The webinar will start around 11 a.m. and the fee to attend it is just 999 rupees. This means that for 999 rupees, you will get to learn about 25 plus high quality businesses that are currently in a high value zone. So if you want to join this webinar, you can message on this number, or you can also register through the link provided below. Now, at the end, if I summarize my opinion, I will say we often see that in many sectors, smaller companies grow fast from a low base and create a lot of wealth. But solar is a sector where I personally believe the competitive advantage will stay with large players. They can invest heavily and stay ahead of smaller players. They also have an advantage in technology and R&D because they can afford to spend more money in these areas. So as long as margins remain high, they can earn strong profits and reinvest them into new businesses and backward integration, which is exactly what Waaree is already doing. The company has planned a large capex of more than 25,000 crore rupees across different businesses. Out of this, around 10,000 crore rupees is being invested in BESS, where they are working on battery packs, containers, and cells. Apart from this, they have also planned around 1,000 crore rupees capex in areas like smart meters, transformers, and green hydrogen. And as I told earlier, around 12,000 crore rupees is being invested for expanding cell, ingot, and wafer capacity. So in my view, the market is currently looking at Waaree only as a solar manufacturer, whereas the company is actually transitioning into an integrated renewable energy player with presence across the entire value chain, from solar manufacturing to transmission and energy storage. So this is a good business that you can study on your own. Right now, the market seems to be mispricing it because it is focusing only on the risk of margin pressure in solar business. But I believe by the time margins will normalize, Waaree would have earned enough money and they would have used those profits to expand into other businesses. Also, at around 25 PE, the downside looks relatively protected. But yes, a heads up, if you are indeed interested in this, you have to plan your allocation carefully because we cannot ignore the oversupply risk altogether either. Now, at the very end, my humble request, if you found this video helpful, please make sure to like it and also subscribe to our channel. Your support through likes and subscribes motivates us and helps us to bring more such in-depth, high-quality research videos for you every week. I'll see you in the next video. Happy investing.